Salam, everybody. This is Investor Shake back at it again with another video. I hope everybody had a good week, although the market definitely has taken a beating with the recent volatility. I'll tell you personally, my portfolio has taken a huge beating, but I'm still holding on to my positions, and quite frankly, I'm glad that we are experiencing a drop in the market because I would consider this to be a correction. I felt that a lot of these stocks were overvalued and were pretty expensive. So now that the stock prices have dropped for a lot of these companies, this would be a good opportunity to get some stocks at a good discount. I was able to pick up some shares of Teladoc and CleanSpark, and then I also did get some fractional shares of Tesla stock, because right now Tesla stock is currently at the lowest it has been in 2021, when we've seen the stock as high as almost $900 a share back in early February, and it has been on a decline for the rest of February and part of March. And quite honestly, these are pretty attractive prices that we're seeing at the $500, $600 mark. Now, when it comes to it dropping even further, it is a possibility. I'm not really too keen on investing in the month of March, as there's a lot of volatility going on around that time of year. But if you're depending on whether you're bullish or not in a company long term, you should still be buying shares into the company, provided that you still have enough money to invest into the market. So this is the beauty of investing in the stock market. If you can handle the volatility, the sell-offs, and the downward trends that we're seeing in the short term, you will come out stronger in the long term, once all this goes away. Once we start to see the stocks turn green and heading upward in their price movements. Again, if you cannot handle the volatility and you end up selling your stocks when they go down significantly, that means you shouldn't be investing in the stock market. If you can't handle the short-term volatility, then what's the point of putting your money in the market? You're better off putting it into a savings account. Now, when it comes to investing in the stock market, I talked about last week on how I am a buy and hold investor, which means that I do not sell my stocks frequently. Well, I'll do a few swing trades here and there, but for a majority of my stocks, I intend on holding them for the long term, with Tesla being an example of a company that I want to hold long term. And the reason for that is, if you hold the stocks for more than 1 year and you sell those stocks, you are taxed at a long-term capital gain, which is taxed more favorably compared to a short-term capital gain. Now, I have a chart that shows the difference between short-term capital gains and long-term capital gains. Now, as a refresher, a short-term capital gain is when you sell a stock after holding it for less than 1 year, and long-term is if you hold it for 1 year or more. This applies to stocks as well as cryptocurrencies. So looking at this chart, you'll see different income levels. Now these are tax brackets, which means that depending on your income, a certain proportion of your income is going to be taxed at a certain percentage. For example, if you make $9,000 a year, you'll be taxed at 10%. Now, the short-term capital gains tax rate is the same exact tax rate as your earned income that you get from your job. So if you make $9,000 a year at your job, you're going to be taxed at 10%, which means that you'll pay $900 in taxes. Now, let's say you make $9,000 a year at your job, but you are a day trader, buying and selling penny stocks, and you hit it big with a penny stock. Let's say you buy a penny stock for 20 cents per share, and for some reason it goes up to $5 a share, and you sell it. Whatever profit you made on that penny stock trade will be considered as short-term capital gains, which will be added to your $9,000. So let's say you made $30,000 on a good penny stock day trade. That $30,000 profit is going to be added to your $9,000 income from your job. So the IRS is going to determine that your income is going to be $39,000 total. So looking at this chart here, if you're making $39,000, the first $9,525 will be taxed at 10%. Then whatever income you have, the rest of your money, from $9,526 to $38,600, is going to be taxed at 12%, which is slightly higher. So which means you'll be paying additional taxes on your profits from the stocks. Now, with your job, they are going to take taxes away from your paycheck every time you get paid. So in a way, you've already paid your taxes for your job, but you did not pay taxes on your stock gains, which means you have to pay those taxes separately when you file your taxes. And for a lot of people, myself included, if you made a lot of capital gains from stock trading, don't be surprised when you see a large tax bill from the IRS. That's why I prefer to be a buy and hold investor with the intent of holding my shares for more than 1 year. Because if you profit on some of your investments and you held on to it for more than 1 year, you are taxed at 0% up to $38,000. Anything more than that, you'll be taxed at 15%. So let's say you bought Tesla shares back in February 2020, and you bought $20,000 worth of Tesla stock, and that position went up to $50,000 in March 2021, and you decide to sell your entire position. That $30,000 profit will not be taxed, since it's between $95,26 and $38,600. you're going to be taxed at 0%, which means that $30,000, you get to keep it entirely. The IRS does not touch it. Uncle Sam does not touch it. And all you had to do was be patient with your investment and let it grow. So this shows you that being a long-term investor, a patient investor, definitely has its benefits when it comes to paying taxes. If you're a buy and hold investor with that strategy, you'll pay significantly less taxes than a day trader. Now, however, if you're certain day traders could qualify as a trader tax status by the IRS if they are serious day traders. So they can deduct a lot of losses, they can deduct office expenses and stuff like that. But if you're a casual day trader, I would highly suggest that you either take a look at becoming a qualified day trader by the IRS or to quit day trading altogether so that you don't have to end up paying a lot of your hard-earned gains to the IRS. Now, as always, I'm not a financial advisor. This video is for educational and entertainment purposes only. Please do your research when comparing buy and hold investing to day trading and swing trading, and be sure to consult a tax professional when it comes time to file your taxes and you have a lot of gains, a lot of capital gains from constantly buying and selling shares. This is Investor Shake, checking out.